Welcome back, everybody. I'm Neil Cavuto. You're watching Coast to Coast, and a roast to rose for stocks of almost all sorts getting hammered today. A lot of it built on oil, but my buddy Gary K. has passed along to me. That would be Gary Kaltbaum, because that's his cool name. We just call him Gary K. Was saying that on top of the 60% of the market that's already bearish, you have this Apple situation today where the stock has fallen below a 6-month low. It's sort of like a trigger, he says, for today's selling. Who am I to doubt him? He's been very prescient on these market moves. So among some of the other reasons for this, and Apple stock has been swooning ever since an earnings report that disappointed some, particularly with the sales of that Apple Watch. Anyway, with Apple falling off and going through a 6-month low, and then the oil situation, the concerns about the global economy and Treasury yields now back to 4-month lows. You know the drill. People are just getting out of Dodge. All right, now investor Bob Wiedemer says that a correction is due. It's here. It's now. Get used to it. Bob, how bad does it get? A correction typically starts with a knock of 10% off our highs. How long does that hold?
I think if you could tell me exactly when the Fed's going to come in and save it, I can tell you how long the correction's going to be. I think this market's going to be very driven by the Fed. Since we're not printing money now, I think it's vulnerable to a correction of up to 20%. I can't imagine the Fed wouldn't come in after a 20% correction. But it could go down that far. 20% would be a bear market. That would be a bear market, and obviously that's something we've not seen. We've not even seen a correction of 10%. So I know people like you have been reminding me underneath the market, underneath the averages, we've got a bear market going, that most stocks are well off their highs, at least 10%. I think close to half, off to 20% off their highs. Oil issues first and foremost among them. But how far do you see this spreading, and who gets gored here? Well, I think you're going to continue to see blood in the oil marketplace. I don't think oil's drop is over. Let's face it, we were adding to inventories during the summer driving season. And that tells you when the driving season's over this fall, you're going to probably have even more carnage there. So I think oil's going to lead the way in problems. But again, the whole market's, I think, in trouble. Partly China is also causing problems. People are getting very skeptical just how much China's growing. How
much stock do you put in the notion that what's going on with oil isn't just sort of technical factors or any of this other stuff, but or a dollar story? It's just a global slowdown story. And that's worrisome for the world's markets.
I think that's a lot of it. Remember, an awful lot of the demand for oil came from China since the 2008 collapse. So with that slowing down, a lot of it's just a slow demand, and production's still rising in places like Saudi Arabia and Iraq and even the U.S. So you've got an imbalance there that's not going away real soon.
You know, and smart people like you always remind me, Bob, that one day does not a trend make. These gyrations could be reversed tomorrow. The fact of the matter is that year to date, these markets are still fairly flat. But you expect that to change, right?
I do. I mean, I think it's just a matter of time. Again, we've really seen this market follow the lack of money printing or the increase in money printing, not so much the economy or earnings. And I think what we're going to find is that it's just a matter of time before this starts to go down further. And I think right now, because of all the external events we just talked about, I think now is getting close to that time.
All right, Bob, thank you very, very much.